Most people know that you can reduce inheritance tax by making gifts during your lifetime. But the rules are a little complicated, and simple mistakes can actually mean that your family ends up facing an inheritance tax bill later down the line that you weren't expecting. My name's Esther. I'm a chartered financial planner at Integrity365 Independent Financial Advisors. In this video today, what we're going to do is look at the 7 most common pitfalls of inheritance tax gifting, from misunderstanding the 7-year rule to forgetting about gifting with reservation, and how to avoid them so that your planning really works. So, pitfall number 1, forgetting the limits of allowances. Some people may or may not be aware that there is a £3,000 per annum per person allowance for gifting. This is something that you can also carry forward for 1 year. That means that in one single year, a married couple could gift up to £12,000. On top of this, you also have unlimited numbers of small gifts up to £250 in value. These can't be combined with the £3,000 exemption. So if, for example, you'd gifted your daughter £3,000, you couldn't then give her unlimited £250 under the next exemption. If, however, you'd gifted your children £3,000 each and then very generously decided to give £250 to every single person you knew, all of those gifts would be exempt, even if those £250 added up to £100,000, as long as you followed the rules. If you have surplus income, you should really consider using the final exemption, which is gifting out of surplus income. Now, gifting regularly out of your income to another person, such as your child or grandchild, or for example, paying for nursery fees for your grandchildren, this is exempt from inheritance tax, as long as it meets certain conditions, including that it is not impacting your own lifestyle and standard of living, and that is surplus from income, not capital. So for example, if it is surplus from employment income and it's coming into your current account and then it's going out as a gift. If, however, it's money you've saved over time, maybe from an ISA or pension or a savings account, and you're drawing from those savings to gift away, that would not be seen as surplus income. And that's where it's really important, again, just to take advice, make sure you're doing it correctly. What you can also do when looking to gift out of surplus income is do a cash flow modelling exercise with a financial planner. What they can do is they can run a series of scenarios and effectively show you how much you can afford to give away without compromising your lifestyle or compromising your future financial goals or retirement objectives. Pitfall number 2 is misunderstanding the 7-year rule. When you gift for the purposes of mitigating inheritance tax, there is a 7-year period. If you die within that 7 years, the gift may fail and be brought back inside your estate. There is something called taper relief, which reduces the amount of tax due on that gift if you die after 3 years. It's a really important distinction to understand that taper relief reduces the tax due on the gift, not the value of the gift. So for example, if I give £100,000 away and then died in under 7 years, some taper relief may apply, but that would apply to the 40%, £40,000 of £100,000, not to the full £100,000 gift. So you've got your taper relief. Death within 7 years can still leave heirs with a tax bill. Death after 7 years of making that gift, as long as you meet all of the correct circumstances that apply to that tax rule, you should be exempt. However, there are some scenarios where actually that gift can be brought back inside your estate for up to 14 years. We're not going to go into that level of detail on this. However, if you want to discuss that further, I really recommend that you take professional advice. Pitfall number 3 is failing to plan for any tax that's due on gifts made within that 7-year period. One of the easiest ways to mitigate inheritance tax is to gift assets away. However, if you are caught out by that 7-year rule and you pass away before that gift is fully outside of your estate, you're ultimately leaving a tax bill all the same. This is where life insurance comes into play. Something called a gift inter vivos policy, or you can also just use a level term assurance policy, can be used to cover the tax bill due on a gift for 7 years. As an example, if you give £100,000 away, and die within 7 years, there is potentially up to £40,000 of tax due on that gift. However, if you put in place a £40,000 gift into Vivos or level term assurance policy, if you then die within that 7 years, then as long as that life insurance policy is placed into trust, that inheritance tax bill will be paid, and that will mean that that gift is successful. This is a strategy that's often underused. It can be a relatively cheap, often only tens of pounds a month, to pay for a short-term life insurance policy like that. And it can leave your beneficiaries exposed to unexpected liabilities if you don't plan ahead and put something in place. Pitfall number 4, gifts with reservation. This is something that we as financial planners see all the time. It's an easy error to make, but it's vital that it's not made. If you give away an asset to someone, anyone, family member, for example, but continue to maintain a level of benefit from that asset, you have not, under the eyes of HMRC, truly given that away. Let's give an example. Let's say you're a married couple and you've got a couple of children. You really enjoy going to Spain in the summer. So you buy a holiday home in Spain and you put it in your children's names, thinking that way it's in their names, it's never in our names, we've effectively gifted the money at that point. We live another 20 years well outside the 7-year rule. Unfortunately, however, that couple have been going there at least once a year, every year, for free for holiday. They are unfortunately still benefiting from that asset. This would be seen as a gift with reservation. The same is often seen when people try to give away the main family home and continue to live in it. Again, gift with reservation. Could even be as simple as you give someone a piece of artwork, but that artwork stays hanging in your house. So it's really, really important to make sure that you do not get caught by these rules. There are ways around it. So for example, the holiday home, they could pay rent every time they go there. It would need to be market rent. But ultimately, if they continue to go to that holiday home for free, they are under those gift with reservation rules, and that gift will not be successful. So take the holiday home as an example. They could continue to pay market rent every time they go and stay there to their children, and that would ensure that they are not falling foul of the gifts with reservation rules. However, if they continue to go there for free, then with all the good intentions in the world, that gift may well fail when they die. Pitfall number 5, overlooking the different types of transfers. There are 2 main types of transfers when it comes to inheritance tax gifting. You have a potentially exempt transfer, or PET, and you have a chargeable lifetime transfer, or often known as a CLT. PET's CLT. A potentially exempt transfer generally would be a gift to an individual, for example. So for example, if I give away £10,000 to my friend, that would be a potentially exempt transfer. And the meaning behind that name is that if I don't die within the next 7 years, then there is no tax due on that gift. However, if I do die within that 7 years, that would be seen as a failed gift, and it would turn into a chargeable lifetime transfer. Now, chargeable lifetime transfers are also able to be made during your lifetime. So a lot of different scenarios fall under this belt, but effectively the most common one is gifting into certain forms of trust would be seen as a chargeable lifetime transfer. It's in the name. If you make a certain type of transfer in your lifetime, you may have to pay some what is called lifetime inheritance tax. One very common example is gifts into certain kinds of trusts are often seen as CLTs. In this case, if you gift into trust and that takes your total gifting over the £325,000 nil rate band that each individual has, in that 7-year period, you may have to pay some 20% tax on anything above that. You've got PETs, you've got CLTs. Potentially exempt means no lifetime inheritance tax unless you pass away within the 7-year period, in which case it may turn into a failed PET, it's known as, and then you would have to pay some tax on that gift if you haven't protected it with your life insurance. And then you've got a CLT, which if it is over the nil rate band during your lifetime, you will pay lifetime inheritance tax of 20%, and there is no recouping that at any point. Those are the two main types of transfer. People often overlook that and don't realise that they're making a CLT rather than a PET, or perhaps don't realise that the PET could fail if they don't live the 7 years. So if you're under any confusion about what kind of gifting you're doing, take advice. The sixth pitfall is assuming that reliefs always apply. Now, the two main types of relief when it comes to inheritance tax is agricultural property relief and business property relief, also known as agricultural relief and business relief. These have been in the news a lot recently. Financial planners have been talking about them an awful lot due to the changes that were proposed in the 2024 October budget. Now, business relief, or BR, and agricultural relief, AR, have quite strict rules, and those rules are subject to change and they do alter over time. Assuming those reliefs apply to your assets without checking them could leave your assets unprotected. Let me redo that. Assuming those reliefs apply to your assets without checking that their legal status does apply could leave you exposed to paying inheritance tax in areas of your assets that you weren't expecting to, or when these new reforms come in, potentially paying more tax on those assets than you were expecting to. One really good example of this in action is if you are farming land and you have some grassland that you cut for hay, where that hay is being sold to could determine whether you get agricultural relief on that land. If your hay is being sold effectively for use in the food chain, so sheep, cows, anything along those lines, you may well be covered. It's a little more nuanced than that, so it's good to take advice, but you may well be covered. However, if you're selling that hay for horses and equine use, or you're using it for your own horses, you won't be covered. Horses are not covered under agricultural property relief. So, very key to make those distinctions. Absolutely key to take advice and find out exactly what different reliefs your different property might fall under. The final area on the sort of business and agricultural reliefs is gifting with reservation. It links back to that pitfall number 4 that we talked about. It's really, really, really important when you are gifting away agricultural or business assets, but continuing to benefit from the business in any way, remaining a partner, for example, or receiving a dividend. It's really important to take advice before you do that gifting and make sure you do it in a way that will benefit yourself and your heirs, and that you don't get caught in the gift with reservation trap. Pitfall number 7, something that is less talked about in the financial planning world, is gifting to charity. So there is a lot of relief on gifting to charity, some income tax relief. You'll all have heard of gift aid, for example. However, there is also inheritance tax relief from making charitable donations. So if you leave in your will 10% or more of your estate to charity directly, that will reduce your overall rate of inheritance tax to 36%. So that's a drop of 4% from 40% tax down to 36% tax, simply because you've left 10% of your assets to charity. Now, I often find that this is one that clients have not heard of when I'm in meetings and are actually really quite enamoured by. So it's something worth considering if you're redoing your wills. Have a think about it. Is that something you want to include to reduce the amount of tax ultimately due on your estate? It's also worth noting that regular gifts to charity also come under inheritance tax relief. So unlike gifting to an individual, if you make any form of gift to a charity, that will be totally free of inheritance tax. So if I decided I wanted to give £100,000 to a registered charity, I would get gift aid on that, so income tax relief, but I would also get total inheritance tax relief, and there would be no IHT due on that gift if I died at any point. Gifts from surplus income can also be a really good way of doing this. If you're going to look at doing larger gifts, or you want to do gifts out of regular income to charity, there's different ways you can do that to make it really tax efficient for you. I really recommend taking advice from a financial planner. What we can do is we can do cash flow modelling to determine how much you can give away so that you can maximise the impact that you're making whilst ensuring that your lifestyle is sustainable and that you're still meeting your own financial objectives. Gifting really is one of the most effective ways of mitigating an inheritance tax bill. But if it's not done the right way, it's really easy to get caught out and end up leaving your heirs with a much bigger bill than you were expecting. If any of what I've talked about today appeals to you or intrigues you, or you think, actually, I could really do with some advice on that, get in touch with us at Integrity365. We'd absolutely love to help you, and we can go into so much more detail than we've done today. Thank you.